All right. I am Hill Laxon, Director for Network Engagement at Women's World Banking. Greetings from New York and New Jersey. Before we formally begin, allow me to share 4 housekeeping items. Number 1, participants are by default muted and off camera. This helps us to focus on the speaker as well as the message. Number 2, we are recording this Zoom event. We will be making the recording available to you as well as to the rest of the network. And number 3, please take advantage of the Q&A and chat functions all throughout the event. Please don't wait until the end to ask questions and post comments. And finally, we will have 5 poll questions, and we hope that all of you will participate. We want this event to be more interactive and therefore more effective for you. Again, a very warm welcome to all of you. 14 network members from 11 countries registered to join us today. If you Google the question, what is the greatest threat in the world today? What answer comes up? Is it pandemic, COVID-19, infectious diseases, conflicts, wars, poverty, failing economy, lack of livelihood? No, it's none of those. What comes up is climate change and variations of climate-related risks. In fact, a study released last January entitled The Impact of Climate Change on Urban Home-Based Workers in South Asia clearly shows how incomes go down as heat and floods go up. It is in this context that we thank you for joining us today in the 5th network event for 2022, a workshop on climate-related risks and opportunities for financial services providers. This event is a continuation of the theme of our 3rd event held last May 4. Can inclusive finance save the planet? Perspectives from practitioners. In that May event, we invited 4 of your colleagues in the network, FWWB India, Equity Group of Kenya, Access Bank Nigeria, and Banco Azteca Mexico to share their perspectives. These 4 network members, together with other NMs like Shakti Foundation Bangladesh, Sajida Foundation Bangladesh, Hasbank Mongolia, and Banco Adupem in the Dominican Republic, already have initiatives to help low-income women mitigate the effects of climate change. To help us better understand the risks and, more important, the opportunities for financial services providers like yourselves, we invited a trusted global consulting firm with expertise in climate-related risks and opportunities, Baringa. Baringa serves many industries, including financial services. Baringa helps their clients to think through their climate change strategies and approaches. Next slide, please. Today, we will spend the time in 4 segments, starting with brief introductions of Baringa and the team, a brief discussion on climate change and financial services, followed by Baringa sharing its climate preparedness toolkit. This is exciting. And the last 15 minutes with Q&A. Again, we encourage everyone's active participation in the Q&A and chat. You can ask your questions even now. Baringa and Women's World Banking will be monitoring the Q&A and will respond to you in real time. NMs, especially those who have valuable experience to share, can also answer questions and post messages and links to their initiatives in the chat. We hope that this event will spark ideas and lead to concrete actions, as well as spur collaboration amongst network members on addressing the greatest threat in the world today. Let me end by thanking Baringa for their generous support in leading this workshop. I'm happy to welcome Emily, Hortense, Carol Ann, and Sasha. Over to you, Emily.
Brilliant, thank you. And thank you so much for that lovely warm welcome. I'm just going to take us through very quickly an introduction to the team, and then just to give you a little bit more information about who Baringa are. So everyone who's here to talk to you today is an expert specifically in the topic of climate and climate risk. I lead our ESG and sustainability practice within financial services globally, which is a great honour and privilege, and I'm delighted to be able to say that to you all. I genuinely believe that if we can work through how we reallocate capital most appropriately, then we can drive the most difference in the world. Hortense, Carol Ann, and Sasha are all part of our climate change and sustainability team working specifically in the US. Just to move on and tell you a little bit about Baringa. So we are a consultancy company originally based out of the UK, where we started particularly monitoring and measuring how energy systems work. And actually that's quite important in the context of climate change, really understanding those systems, how they need to change, and therefore how the knock-on impact that have. So we are about 1,200 people globally. I'd say a large number of those work specifically in climate change, and we work across the energy sectors, we work with governments, we work with many global financial services institutions, specifically supporting them across a wide range of topics, but climate change being our #1 priority. We're a very purpose-led business, and actually this has been the heart of our strategy, as well as the broader topic of sustainability. We recently announced we became certified B Corp. We're absolutely delighted to be a consultancy company that's been able to kind of achieve that fantastic standard of demonstrating how we consider the environment and social impact of all of the work that we do, but also that we're able to actively and accurately measure and monitor that through our governance processes as well. Moving on then, just in terms of the types of work we do, it's really, really broad. We've been working in this space for over 22 years actually. And what are the types of things we do? Well, actually, we feel we've been shaping the market's response to climate change. Why do we think this? Well, because we built a climate scenario model. We have a partnership with BlackRock to continue to go to market with that model. But more than that, really that we've been knocking on people's doors for at least the last 6 years, often when they didn't really want to talk to us about climate change and they thought we were all tree huggers. We weren't necessarily met with an open door, quite frankly, but actually through our perseverance, that's enabled us to have a fantastic position in the marketplace, really knowing and understanding and being at the forefront of some of the climate change considerations. We're working with governments globally to partner with them specifically on how they deliver their net zero commitments. I think I talked about our history being in energy and environment. We are rated the #1 energy and environment advisor as well as rated by the FT here in the UK. That's not us saying that, that's actually because they ask our clients and they give that feedback, and that's all properly monitored and kind of corroborated. I talked about our climate scenario model that we have in partnership with BlackRock, and also, as I said, really purpose sits at the heart of what we want to do. So for us and the team here, what's important to them every day is getting out of bed and being able to really have impact and drive purposeful change in society. That's everything from me. Thank you.
All right, we're now going to discuss the trends and implications of climate change for the financial services industry to provide some context for our discussion today on why firms must prepare for the risks and opportunities of climate change, and of course, the best practices for doing so. We're seeing immense global attention and steps toward collective action to address climate change. There is broad recognition of climate change as a source of major systemic risk. And in response, there are growing regulatory requirements on firms to manage these risks. We're seeing investors also calling for mandates that incorporate sustainability and manage the financial risk posed by climate change. And we're seeing growing global political support for climate action and net zero commitments, responding to social movements and climate initiatives, calling on governments to increase mitigation practices and fuel investment needed for the energy transition. We're seeing financial institutions respond in a variety of ways to this pressure from regulatory bodies, investors, and these growing political agendas. For example, we're seeing firms disclosing more on their climate impact and climate-related risks, setting financed emissions reduction targets, and responding to these new regulatory requirements. We've highlighted here key climate-related regulatory developments across the globe, relevant in particular to financial services institutions. Unsurprisingly, Europe has remained a guiding and leading force in developing climate regulation over the last few years, with the US a close step behind, with important proposed regulation coming out like that from the SEC on greenwashing and climate risk disclosure requirements. But we're also seeing Latin America, Africa, and Asia begin to assess climate risk, mostly with stress testing and scenario analysis modeling, increase required disclosure of climate impact, and regulate sustainable finance products. We anticipate the regulatory landscape in these regions to accelerate immensely in the coming years, which necessitates firms to actively and responsibly engage in the energy transition. Firms should anticipate regulatory developments by undergoing routine regulatory horizon scanning and staying abreast of climate risk management best practices. And the discussion of best practices will be the focus of the rest of today's discussion. We now like you to respond to the first poll question of the event. Which of these drivers to address climate change has your institution experienced the most, if any? These are the global drivers we just covered that have been pressuring the financial service industry to act on climate change.
We'd like to encourage the attendees to respond to the question, please. Unfortunately, Carol Ann, I don't think we are seeing any responses from our attendees. Maybe we can move ahead.
Yeah. They're still voting in right now. I can close.
Okay, perfect. Thank you.
Wow, okay, equal across the board, very interesting. We definitely noticed within our clients and you know, our scan of the industry that regulatory pressure and investor pressure seem to be the key two elements here driving action. But it's interesting that the political, economic, and societal change is also fueling this as well.
Yeah, and now we can move on to the next section. Thank you, Carolyn. So now that we have covered a variety of global drivers for change and zoomed in into some of the prevalent regulation across the globe, making this change a reality, and actually saw that you see the effects of these drivers equally across the board, we would like to cover the basis on some of the variety of impacts climate change has on financial services institutions and further. So displacement takes front and center stage of climate change associated impacts, with the risk that by 2030, additional 80 million people will be displaced and other 100 million will fall below poverty line, which of course has a disproportionate effect on developing countries. The hard truth is that according to the latest science, 20% of the planet may also be too hot to be habitable. From the economic standpoint, climate change could lead to as much as 520 billion in annual consumption losses, which in turn will inevitably further widen the gap between developed and developing nations, adding to the existing economic inequality. Some aspects of climate change impact some areas more than others, including some very specific implications for developing markets that stem from fuel dependency. Many developing countries depend on petroleum and natural gas consumption for economic growth. And these countries view constraints on carbon-intensive energy as detrimental towards their economic expansion. Hence, reducing energy consumption or shortage of energy supply has serious implication for income in emerging markets. Furthermore, governments in those areas oftentimes have other priorities on their agenda, and failing to incentivize the market to consume energy from renewable sources. Next slide, please. So moving on, another important aspect to consider and be familiarized with is the climate change disproportionate and disastrous effect on women. Of course, it is particularly relevant as everyone present in the room here is an active member of Women's World Banking, all working together to drive women's financial inclusion. So how does climate change disproportionately affect women? 80% of all displaced people by natural disasters are actually women. They're also less likely to survive and more likely to be injured in these times. Additionally, as a result of this displacement, women and girls face specific challenges, including separation from support networks, increased risk of all forms of violence, and reduced access to employment, education, and essential healthcare services, including sexual and reproductive health care and others such as psychosocial support. Additionally, as a result, women and girls face increased vulnerabilities to all forms of gender-based violence during these times. Another aspect to consider of the impact of climate change stems from women's role in agriculture. So in fact, women represent around 43% of the global agricultural workforce, but they face countless barriers to economic independence. According to one of the World Bank reports, at least 155 out of 173 studied countries have at least one law impeding women's economic opportunities, which further lowers women's voices in driving change. And the problem really comes to their service when we look at the following statistics. While women represent nearly 50% of the agricultural workers in some countries, they represent only 20% of landowners. And without land ownership, women are less likely to adapt by using sustainable farming techniques and techniques that technically respond to climate change. And reliance on agriculture poses a risk in the face of climate change. We can move on to the next slide. So now let's turn the attention to the broader financial implications of climate change on financial services institutions, from impacts on balance sheets to revenues and costs. First of all, we can categorize the impact of climate change into two main categories, as you can see on the above the slide: physical risks and transition risks that all have different implications on your business models. Physical risks such as air and water pollution, rising global temperatures, extreme weather events, and even water and food scarcity could lead to a wide variety of business risks. For example, a number of assets that you have in your business could be impacted by exposure to severe weather events, which could in turn reduce the asset's useful life or affect its salvage value. Another example, similarly, because of damage from extreme weather events, insurance costs for the business could see a significant increase. As we move to transition risks, we see categories such as policy and legal, technology, market, and reputation, all of which have an impact on your business as well. An example of a cost consideration is the impact of regulation and compliance associated with climate change impact. As we saw earlier, regulatory pressure is one of the most important drivers of adoption to climate change, and the regulators do not only create incentives to drive more sustainable practices, but also punish those that do not comply. This is something that we see evolve, particularly in the US side market. As an example, just recently, one of the largest US banks was fined by the SEC in line with an appropriate and misleading use of its ESG dedicated fund. And we expect to see a lot more of similar fines in the near future as regulation continues to evolve and becomes more stringent in this space. Another example of technology or market risks having an impact on business balance sheet could come from other sources, such as impacts on taxes due to new carbon emissions and products such as green bonds, which we also see evolving a lot. Revenue and cost could also get affected by introduction of new emission pricing and regulation in the market. Sales could also get affected by reputational damage as consumers are becoming more conscious in their purchasing decisions, and expectations on acting on climate change from businesses and financial services in particular is increasing. So all in all, climate change impact is very dramatic and poses significant risk for financial services institutions, particularly in emerging markets, which now brings us to the next part of the workshop today, dedicated to how you can prepare to deal with these risks and impacts. And I will pass it on to our Tans to continue this section.
Thank you, Sasha. And as Sasha explained, we now have covered some of the drivers of climate change. We understand a little bit more what are the impacts on the balance sheet, what are the financial implications of climate change. So now let's think about how can financial institutions get ready and prepared to really embed climate change as part of their operating model. If we can move on to the next slide, please. So we talked about those three main drivers, right? The global regulatory pressure, the investor pressure, and the economic and societal changes. Now we like to see, and you'll probably see different frameworks depending on who is presenting the topics. But the way we like to present the response toolkit to our client is broken down into three main categories. The first one is more about how to protect properly the balance sheet, how to really integrate climate risk as part of risk management framework. So it's all about risk modeling, risk management, and reporting. And then there are, I would say, other type of responses that the company has to be ready for. And it goes with really understanding existing internal emissions, carbon emissions, understanding portfolio emissions, and understanding how to actually be able and have some tools to do carbon offsetting. That's still looking at the internal impact of climate change. And thinking about the external impact of climate change, it's all about what financial institutions have as tools to enable the transition to a low carbon economy. So it's about new sustainable products, new sustainable investment screening and strategy, and technology investment. So we like to see this toolkit being broken down across those three main categories: risk management category, understanding of own carbon impacts throughout the company, and then proposition to the other external stakeholders on helping the transition to a low carbon economy. So we're not going to spend a little bit of time on the risk management portion, which is really how to embed climate risk as part of existing risk management framework. But before we do that, I'd like to open us to the second part of the day, which is to understand a little bit more about the integration of climate risk as part of your existing risk management framework. So first question is if you consider that climate risk is fully embedded into the risk management framework, or if there are some specific aspects of climate risk which are incorporated, or if you are considering climate risk as a totally separate element of your risk management framework, or if none of those are applicable. So feel free to answer the question, and we can then go deeper into the topic. That's very interesting. And actually, I'm glad to see that we have 17% response which consider that climate risk is fully integrated into the risk management framework. It's definitely in line with what we are seeing with some of the financial institutions that we are working on. We are seeing more and more focus on really trying to think about climate risk as a separate driver, but ultimately being able to embed it as part of the existing risk management framework. But we're going to touch upon that. So thank you for answering the question here. So moving on to the next slide. Thank you. As I mentioned, we're going to spend time on the risk management portion, which is what type of activities, what type of changes need to happen to really fully embrace and fully embed climate change as part of the existing operating model. So the way to think about it is to actually align to existing frameworks. So here you're going to see actually 5 pillars, which are strategy, governance, risk management, scenario analysis, and targets and disclosures. For those of you who have actually responded that climate risk is fully embedded into their existing risk management framework, I presume that those pillars are you're probably familiar with those pillars. For those of you who are not necessarily familiar with climate risk embedding, those pillars are typically frameworks that we are seeing commonly being used as industry standards, and especially through TCFD frameworks, TCFD reporting. So we always encourage our clients when they start their journey around climate risk embedding to really anchor into this framework, because it's really helps understanding how tactically they can start embedding climate risk. So I'm going to touch upon each of those a little bit and discuss some of the challenges and best practices that we are seeing across those different pillars. Knowing that obviously there are a lot of external challenges which are not necessarily pertaining to the financial institution itself, but external challenges such as the lack of prioritization of climate in different governments. So I'm going to take the US as an example because this is the market that I'm more familiar with, but because now we're seeing a little bit more momentum around embedding climate risk as part of a risk management framework, but we're still not there in terms of putting actions into rules. And so when talking to clients, it's very hard for them to move the needle, especially when working with very big companies. Because there is a lack of prioritization of the topics, there is obviously potentially a lack of budget and resources. So those are external challenges that unless the government is really taking action in embracing climate change, there is not much that they can do on their own. Obviously, a lot of economies are depending on fossil fuel industry, so it's very hard to think about how to move to a low carbon economy while companies are so much exposed to fossil fuel industries. And then I would say the last item is about, in terms of challenges, is about the lack of consistencies in industry standards and procedures to allow for transition. So that's why here again we're anchoring into the TCFD framework, which is one of the most used framework across the globe. So going back to what it means for your company and what it means for your risk management framework, it all starts with embedding climate risk into strategy and setting, I would say, the right ambitions. So most of the time, if the if the change is not coming from the top, if the tone is not set at the executive level, it's very hard to get things moving, especially because the climate risk embedding touch a lot of different functions across the financial services. So there is a required definition of the strategy that needs to happen at the top of the house, and making sure that there is consensus and overall buy-in on the level of ambition around climate risk. The governance is extremely important, and if we are looking at some of the trends and that we're seeing across the globe, there is more and more ask, especially from investors and regulators, to ask for board, senior committees to take ownership and accountability when it comes to embrace climate change and ensuring that the financial services is protected for climate risk. So understanding exactly what the right governance needs to be and what are the right forums and right people to actually involve will definitely help getting this topic fully embedded. And then the third pillar is obviously the risk management function. So how to actually embed climate risk as part of the risk management framework. So we talked about two main approaches. One is considering climate risk as its own driver. We're seeing companies doing it just to really have the key focus on climate risk and the importance of climate risk, and making sure that people understand that things need to be changed. But ultimately, what we advise our clients to do, and what we're seeing the industry starting to do, is to fully embed climate risk as part of existing risk types. So if you think about the impact of climate risk, it impacts credit risk, it impacts liquidity risk, market risk, etc. So there is a need, even if considered as a separate climate risk driver, that ultimately climate risk will be fully embedded into each level 1 risk types. So what does it actually mean when we're saying embedding into each level 1 risk types? It means that there is a need to do proper risk identification and assessment, really understand the materiality and the impact of climate risk across the different risk pertaining to the financial services. There is a need to actually start thinking about how to adjust the risk appetite of the financial services to take into consideration climate risk. And then obviously there is a need to measure and monitor properly, and to have proper reporting mechanism to really be able to report on climate risk. And to do that, to do all these activities around risk identification, risk appetite statement, reporting, we see most of the companies starting to consider and investigate specific tool capabilities such as scenario analysis. So I'm not sure how many of you are familiar with this topic, but scenario analysis is becoming a common climate tool to be able to really understand and assess the impact of climate change into the balance sheet, and really taking action in terms of monitoring and mitigating the impact of climate risk to the balance sheet. So we're going to talk a little bit more on scenario analysis capabilities after, but obviously some of the challenges that we are seeing around scenario analysis as of today is the lack of data available, but it doesn't prevent companies to start thinking about how to implement scenario analysis tools and capabilities with the existing data available and with the existing scenarios available, such as MGFS, etc. So if we move on to the next slide. So which of these challenges to embedding climate risk into your business is most impactful for you? Is it the organization buy-in? Is it funding and resourcing, data access and availability, as we just mentioned? Or is it the integration of climate risk into existing process, of lack of clear standards and procedures to transition? We should have put all of the above. I don't know if we can have multiple selection. Very interesting. Organization buy-in. Yeah, I'm not surprised. And actually, it's interesting to see that the rest is quite balanced. No funding and resourcing issue. That's good to know. Organization buy-in. It's totally aligned with what we're seeing, and I think it actually ties back to the comment that I was making a little bit earlier around the importance of government actions and decisions in order to get the organization buy-in. We know that in the globe today, there are a number of advocates and company, corporate, financial services which decide to take the lead, to be leader in climate change and pushing for the transition to a low carbon economy. But others are waiting a little bit for governments to really push that into rules. And without that, it's very hard to move the needles in financial services and private companies. So totally aligned with what we're seeing. Thank you for responding. So moving on to the next slide, please. We wanted to make it a little bit concrete, and I touched a little bit upon some of the activities that need to happen when it comes with climate risk embedding, but we thought it would be helpful, especially visually, to think about what concrete actions your organizations can take to start their climate risk embedding journey. So here we put an example of some support that we gave to a large US bank in terms of advising their climate risk leads on how to actually move forward their journey around climate risk embedding. So what happened is that this bank actually made public commitments on the fact that they will fully embed climate change as part of their risk management framework. And so our role here was to help the client interpreting what this public commitment made really meant for their day-to-day activities, and what different work stream they had to put in place, what's the program, what's the type of program that they had to put in place in order to be able to meet this public commitment. And this is actually a trend that we are seeing. A lot of companies, especially around COP26, a lot of companies have made a lot of commitments, public commitments, such as net zero commitments or climate risk embedding commitments, and then realize that they needed to take action in order to be able to show progress against their commitments. So what happened is that we help our clients across 6 different work streams. And the work streams are actually quite aligned with the framework that we were presenting a little bit earlier around strategy, governance, risk management, scenario analysis, and reporting and disclosures. Although here we were really focusing on the risk management component only. So the 6 work streams that the client had to push forward was around the risk identification and assessment. So that's the point I was mentioning earlier, which is, how do you ensure that the company has identified all type of physical risk and transition risk that impact the company, and how to actually assess the materiality of those risks. And when you think about it, it's also, how does it impact each risk type? It's not necessarily, again, it's not seeing climate risk as a separate driver, but really trying to understand the impact of climate risk into existing risk categories. They had another work stream which was around the risk appetite. We're seeing across the world a lot of companies trying to have a specific risk appetite for climate risk. So it's usually a more qualitative statement, but it starts to move to more quantitative statement. But for this specific client, we advise them to start thinking about qualitative statements. So it could be statements such as not investing in specific industries such as coal, etc., or being a little bit more specific on percentage of activities that needs to be against fossil fuels. We never advise our clients to exit from a specific industry. It's more about ensuring that clients are advising properly those industries into a more carbon-free or carbon neutral economy. The third work stream that we helped the client with was around scenario analysis, which was a real struggle for this company in terms of understanding properly what type of capabilities and how far they had to go through scenario analysis and what type of scenarios they had to choose. The first one was around reporting. and data analytics was also a big struggle. So we help our clients with this one as well. And then we did training and culture, and we didn't necessarily touch upon that a lot, but we see that our clients are really struggling with the training and culture portion, because as you see, a lot of that impacts all different functions. So the front office, the risk management office, the strategy teams, the sustainability teams, data and technology teams. So there is a need to upskill existing resources to ensure that there is proper knowledge of climate change and climate risk across the entire company. So we help the client with all those different aspects through their work streams. And what concretely we delivered for them was what we call the climate risk target state. And I would advise anyone who hasn't started their climate risk journey to start thinking about their target state. So we talked about climate risk as being a separate driver, or climate risk fully embedding into risk type. What is the level of ambition for each company in terms of climate risk embedding? And so that's why a target state is very useful, and target state usually evolves throughout the time, especially with a topic which has an impact through such a long time duration. But it's important to start putting pen on paper in terms of how do we envision climate risk in the future, and how do we envision it impacting each of our risk management frameworks. So we put that into place. But behind this climate risk target state, the most important thing is also to start thinking about roles and responsibilities within the company. So we also help the client putting a race sheet together in terms of really identifying different accountabilities, roles and responsibility across the entire company. And then it starts to get socialized, right, and get some blessing, and people can start having actually the proper plan behind this target state and behind these roles and responsibilities. I could go forever on this one, and I'm conscious we only have 15 minutes left. So I'm happy to take questions on the side if there people want to understand a little bit more what we did for these clients. I would just note before passing it over to Caroline that this is just the beginning of the journey for this client. Don't think that this is done because they've done a target state or they've done a roles and responsibilities and they have six work streams already planned. It's in a very complex topic, but the fact that they have a vision, they know what is the target state, what they're aiming for, has really helped them getting things moved, and also getting resources allocated to each work stream, getting budget approved to start moving the needle. Maybe we can move on to the next slide, which is our first poll on the incorporation of climate-related issues into your risk management framework. So which climate risk do you actually prioritize? Are you prioritizing both physical and transition risk only, physical risk only, or none of those? I'm going to guess that a lot of physical risk is going to be the response, but I might be wrong. I was totally wrong. Well, that's great. So both physical and transition risk, 33%, and transition risk, 33%. So the reason why I was thinking physical risk would be probably more embedded is because we've seen financial services being a little bit ahead in terms of, especially if we're thinking about insurance companies, being a little bit ahead in terms of really trying to assess natural disasters impact, for example. So starting with flood risk, etc., and having a little bit more issues to really understand the different drivers of transition risk. But glad to see that transition risk is well covered here. So I think we can move on to the next section or next case study.
Yeah, thank you, Hortense. So as Hortense just mentioned, in that embedding climate risk into your operating model, We're seeing more and more financial services institutions utilizing climate change scenario modeling, which assesses the future value of their balance sheet under differing physical and economic environments. So this is a great tool to enrich your climate risk management activities, to understand how your investments will impact the climate and how they will respond under various conditions, likely and unlikely, favorable, unfavorable. Once you understand your financials under possible future scenarios, you can identify opportunities that may improve your climate impact while also making commercial returns. And as Emily mentioned at the beginning of the presentation, Baringa has its own award-winning climate change scenario model, which has been developed over 20 years to help financial services manage their climate risk and set their net zero strategy. And the model is now being integrated into BlackRock's Aladdin platform to set the global standard for climate analytics. The figure on the top right illustrates the performance of a portfolio under two differing temperature scenarios, highlighting the impact of different energy, economic, and physical conditions on financial performance. The figure below demonstrates how scenario analysis can facilitate peer comparison and benchmarking to understand if your climate exposure and preparedness is in line with the broader industry. We now have a case study around implementing scenario analysis with one of a global asset manager. Not going to go into too much detail because of time, but we'll circulate the deck afterwards. But we were using 3 different energy and temperature scenario pathways to assess the future financial performance and temperature alignment of 2,500 companies and 5,000 bonds across this client's top 4 funds. And the results were used to inform the client's internal risk management practices, assess alignment with broader climate and net zero goals, and understand the unique use of the output data for the client's internal business units and strategy. We now have another poll to assess your climate scenario analysis modeling activities. Whether you undergo scenario analysis, you're planning to soon, or you aren't, and the reason why you are not currently. Interesting. Yes, we do often see clients reach out to third parties to undergo this sort of exercise because it is quite intricate and requires a lot of expertise. So it is hard to completely leverage internal employees to undergo these sort of activities. So that definitely aligns with our experience.
Yeah, and if I can just add one comment here very quickly, because I know we're running at time here, but what we're seeing is, as Karen was mentioning, financial services asking for third-party providers support, but not necessarily just to implement scenario analysis capabilities or advising on which scenario analysis capabilities need to be set up, but also more to knowledge share and upskill the team. So then for more mature financial services companies, we're seeing that at some point when they have a good understanding of the different assumptions, the different variables entering into scenario analysis tool, they actually start developing their own custom scenario analysis capabilities and ultimately maybe stress testing capabilities. So it's about a journey. Having a third party helping with implementing scenario analysis also help the companies and the different people involved in a risk management function to start embracing the topic by themselves. So it's a journey here.
All right. So moving into a different topic here, we're seeing financial institutions beginning to engage with companies in their portfolios to ensure their portfolios are aligned with their broader climate and net zero goals. To ensure your financed emissions reduction goals are met, it's essential to ensure the transition plans of the companies within your portfolio are credible and aligned with the latest science. Here we've outlined some key questions to consider when assessing the quality and credibility of a company's transition plan within your portfolio to ensure that alignment. All right. And lastly, we wanted to highlight a key opportunity, a climate-related opportunity, and that's the vast investment needed to reach net zero. Baringa and BlackRock modeling suggests $350 trillion of investment is needed to get to net zero by 2050 to ensure only a 1.5 degrees Celsius temperature increase compared to pre-industrial averages. The biggest investment opportunities, as you can see in the figure on the left, are in the power and transport sectors, mostly in renewable technology development. So investing in companies developing these transition technologies is a key transition activity and will help propel your net zero agenda and reach these overarching goals.
Thank you, Caroline. So we saw how disastrous the implications of climate change to your business are and went through a wide array of actions that you can start considering as a business to help prepare for this change. And also earlier, we covered how disproportionately climate change affects women, and their limited access to financial inclusion further widens this gap, lowering their voices in the changes that are taking place. And we just wanted to highlight how financial services have the power to help deal with this problem and can help promote women's financial inclusion in a variety of ways. So promoting women's and girls' full and equal participation and leadership is crucial because this could help make natural resource management and climate, environment, and disaster risk actions more effective. You can do this as an institution through partnerships such as Women's World Banking, as well as other nonprofit organizations that are helping tackle this problem. Educating customers and increasing awareness of broader population is also crucial, including another solution such as expanding gender responsive finance at scale for climate and environment actions to reach women's organizations and cooperatives. Developing social financing products directly aimed at the problem could also help women's inclusion. And another problem that we also see very prevalent in the market is limited or poor quality data availability. And a solution that you can undertake is partner with counterparties and work on this engagement and partnerships to enhance the availability of gender statistics and the quality of sex disaggregated data. So being conscious of time, we can move on to the key takeaways. So we went through a lot of deep content today, and as the presentation part of our workshop comes to an end, we wanted to also summarize the key benefits to financial services institutions coming from addressing climate-related risks and embedding climate preparedness into your businesses and operating models. So firstly, given the increased attention on climate change in the society, adopting sustainable practices in a transparent and accountable way will help your institution in building the credibility and trustworthiness from the public globally. We also see that many financial services that are leading the way have in the space have become leaders in the business, which in turn led to the creation of unmatched reputation and opportunities, from increased market reach, from new sustainable finance products to new customer bases and global expansion. On the internal side, it also helps make your business a lot more resilient. And we are also seeing that financial institutions with sustainable practices and those institutions who have embedded climate risk into their operating models also experience a lot more stable and long-term financial returns affecting their balance sheet, which is also an important consideration. And given the time, that concludes our presentation, and we would like to open the floor to any questions you might have on any of the information we covered today, which is a lot.
Yes, we have about 3 more minutes. If there are any questions from our participants, we had participants from Lebanon, Cambodia, Bangladesh, Dominican Republic, and Nigeria. Some of them are still here. So if you can write your questions, feel free to do that. Or your comments on the chat or Q&A. If there are none, maybe last words from our friends at Baringa, and at our end at Women's World Banking. We would like to extend our deep appreciation for Baringa investing in the future, particularly in the sense that we need to plant this seed of awareness. Oh, there's a question from the Dominican Republic. How we can help clients in the climate change agenda? So it's not the institution, but the clients themselves.
Yeah, that's a very good question. And we touched a little bit upon that throughout the presentation, but that goes back to the products and the opportunities portion that we mentioned. So I think the way to support clients is to inform them about climate change. That's an extremely important part, and we've helped clients being skilled themselves to be able to talk to their own clients about climate change and the implication of climate change for their own operating models. So there is a little bit of education that you can do yourself to your clients, and then it goes to advising them on potential new products that can help them transitioning to a low carbon economy. So we talked about sustainable finance. This is an extremely important topic, which is how to finance the economy with more sustainable products. So this is kind of the role that we're seeing financial services playing with their own customers, educating them to the impact of climate change on their own business. And secondly, proposing new products for them to be extremely interested in being able to transition to a low carbon economy. So some of the products that come in mind quickly is products around renewable energies, for example, for oil and gas companies and energy sectors.
Thank you for the response, Hortense. And I guess that's a good ending to our workshop today, where the focus is on the clients. At the end of the day, it's not about the institutions, it's about the clients. So we thank you very much for that question and the refocusing, and Hortense answer that this is all about also education at both the client and as well as the institution end. So this is a part of our effort at Women's World Banking to plant the seed of awareness on climate-related risks and opportunities. With that, again, our deep appreciation to Baringa, and have a good day to everyone.
Thank you for having us. Have a good day.
Thank you.